What is good, YouTube? It is your boy Sam, and I am back with another video. It's been a very long time since I dropped a video, okay? And I know I've been telling you guys to remain consistent, but I have been consistent. I've just been consistent behind the scenes. As you could tell, the quality is a lot better. The audio is a lot better. That is because I am using my brand new camera here, as well as my mic. Okay, I got them as a birthday gift, and so now we could get back to work, right? I had some issues before to where the first time I tried recording with this about 2-3 days ago, it looks like I bought a bootleg SD card on Amazon. I didn't mean to, and so I'm not really hip to all the new technologies and the content technologies that you need, and so I just figured I'll get the most affordable one on Amazon, but it turned out to messed me up a little bit, right? Because I tried recording a video. I had a nice hour-long video for you guys, and unfortunately it deleted. But don't worry, I'm back. I'm overcoming those small obstacles I said you need to overcome in previous videos, and this video is going to encompass pretty much everything that we talked about, from being motivational, right? Being consistent, making sure you follow the stocks that you plan on trading on a daily basis, adding stocks to your watch list, how to find stocks. What do you do when the stock goes down, right? And that was not your initial plan. So we're going to discuss all of that today here, okay? I also have my setup behind me here, and we are going to be having a visual representation of the things that I talk about. So all my visual learners out there, don't worry. Instead of just hearing me talk all day, you actually have some visuals now on what it is that I'm talking about. And you guys could pause the video, make sure you take notes, rewind it if you need to, do your own side research if you need to, and come back to the video. And that way we can learn. Okay, that is how you learn. I am not expecting you guys to sit down, listen to this video, and just absorb everything. That is not going to happen, and it's okay. Don't get frustrated. I plan on dropping many, many more videos after this. So that is why it is important for you to subscribe, okay? So hit that subscribe button. Make sure you like the video, give it a thumbs up. Let me know if you like it. Get in the comment section. Give me some constructive feedback if you need to. If you got things to share, things that you want to see, put it in the comment section, okay? And I'll make sure to interact with you guys, okay? So subscribe, like, comment, and of course, you got to share the video, right? We got to expand the community. Not everyone's going to be receptive, but you know, you could lead a horse to water, but you can't make it drink, okay? And that's pretty much where we're at now. So the first thing we're going to do is we're going to look up different companies or different stocks we could trade, potential stocks. Because I remember when I first started out trading, one of my major concerns were, how do I find a stock? Where do I look? Is there like a specific platform? Should I be looking on Google? Should I be looking on Yahoo? The answer is yes. Yes. Now, what does that mean? Exactly. That's exactly what it means. There is no perfect or specific place that you need to look, right? And so for this video, we're going to use Yahoo Finance, but it's just a search engine. You can use Google if you like, but Yahoo Finance being that I've been using that when I just started trading, so that's what we're going to use. Okay, so I'm going to go on yahoofinance.com. All right, guys, we are on Yahoo Finance. I'm sorry if I was out of frame there. It's my first time recording with this camera, guys. Well, technically my second, and so, you know, we will improve as we go along. This is not going to be perfect, but I just got to make sure I get all the information off of you. So you go to yahoofinance.com. This is what you will see, right? So what you want to do is, and I'm going to be using this Apple Pencil just to better point out the things that I'm talking about. This is not actually interactive with the screen. This is for my iPad, but you guys get the point, okay? So you're going to go to market right here at the top. Once you go to markets, you go to stocks, and for this sake, right, there are different options. You could do most active, basically the most active stocks for that day, day gainers, so stocks that are up for the day losers, stocks that are down for the day, trending. If there's some kind of news going on or some unusual trading going on, it's going to be in trending. High dividend, you could essentially get paid dividends for having shares in a company for a particular time and get paid periodically. We could do small cap. So small cap is basically the net worth of the company. It's market cap. Market cap is like the net worth of a company. Small cap is essentially a company that has a small cap, essentially, right? A small net worth. And we have large cap, which is the opposite, right? So companies that are huge in terms of market cap or net worth, right? So your major companies, your blue chip companies, your Apples, your Nvidias, your, you know, Teslas, things of that nature. Then you have most expensive, it's pretty self-explanatory, right? Stocks that are just high in share price. You got highest beta, pink sheet, and unusual volume. And we'll get into those a little bit later. But for now, we are going to use stocks. We're going to go to stocks, then we're going to click large cap. Now, you might be saying why we're going to click large cap. There's no particular reason. My thought process behind large cap is that the company is a very successful company, relatively speaking, to other companies on the market. And so as you can see here, the market caps are listed, and it's showing you the trillions and trillions of dollars that these companies are worth. So up top we have Nvidia, we got Google, we got Apple, Microsoft, Amazon, SpaceX. These are all things I'm sure you have heard of before if you've heard any company names being brought about when looking at stocks. So some things you can do. We're going to pick let's pick a random one. We're going to pick Nvidia Corporation, right? Only because it's the first one. Nothing special compared to the other ones that I'm seeing. I just picked the first one to get you guys to understand what it is that you need to do when it comes to vetting for a decent stock to trade if you don't know where to start. So I clicked the symbol, it expanded it, right? It's showing you Nvidia Corporation, the title of the company. You know, sometimes you'll just see the symbol, which is NVDA. However, this expands it. And if you don't know what NVIDIA is, you can see what's happening here with NVIDIA. It gives you a description, and I'll read it for you. I know it's kind of small, guys. It says, NVIDIA continues to lead the tech sector, contributing significantly to the combined market value of the top U.S. stocks, which stands at $25.3 trillion. Analysts highlight strong AI-driven demand for NVIDIA's products while cautioning about supply chain complexities and market risks. So the major thing here is AI, okay? AI. So if you're interested in AI, you believe in AI, NVIDIA is probably a company that you would want to invest in, okay? And that is just, you know, focused on the goals of the company and where you see the company going, okay? Now these charts, it looks complex, but I like to use Robinhood Legend, and we'll cross over to Robinhood Legend here in a second so that we can see NVIDIA, and I could show you the tools that I use and the different candlesticks that I use to determine where I believe the company that I'm looking at is heading. And with that, I'm able to make a confident prediction on, you know, whether I'm bullish, where I think the stock is going to go up, or I'm bearish, I think the stock is going to go down. All right, so we're going to cross over to Robinhood Legend here soon. Let me just type it in, what it is that I need. So I'm going to type in NVDA. So bear with me, guys. You don't see it on the screen now, but you will in a couple of seconds. Okay, bam. Guys, NVDA, okay, trading at $205.60, right? You can see it reflects the same thing here, $205.61. This is live data, guys, so it is constantly changing, but I'm showing you how it reflects the same price as it should on whichever platform you decide to use, okay? Given that it is a credible platform, I can't advocate for every single platform now. So what I'm going to do is I'm going to show you how to read a chart using indicators. Indicators is basically AI tools that determine where the stock has been and where it's going to go. It is very important to use these tools if you have no way of analyzing just by looking at candlestick charts. Okay, so this is what I call a candlestick chart here. This is a 4-hour time frame chart over a, I don't know what time frame this is. Let me zoom out. Let's say 3 months. Let's look at the 3-month chart. There you go. So 3-month chart right here at the bottom. Sorry guys, I'm working on pointing this camera, right? At the bottom here, 3 months, you have your 1 day, your 1 week, your 1 month, your 3 month, your year to date, your 1 year, your 5 year, and all for the existence that this company has been on the stock market. Then here you have your intervals, right? And so let's say 3 months, I click 3 months here. What does 3 months do? It shows me what this company has been doing in the past 3 months. Okay, this is all the price action. And if I click this here at the bottom for intervals, you have the option of doing 1 tick, 144 ticks, 1 second, 30 seconds, 1 minute, 5 minutes. You got 15 minutes, 30 minutes, 1 hour, my favorite 4 hour, and the 1 day, and even 1 week. Okay, and what essentially that means is, for these intervals, each candlestick represents the time frame in which you picked. So let's look at the 5-minute chart, for example, right? Let's look at the 1 day, 5-minute chart. So essentially, each of these candlesticks here represents 5 minutes. What did the stock do in 5 minutes? Okay, and we talked about this in previous videos. If you haven't seen it, go look at my video where I talked about candlestick charts. But what essentially happens is, and we'll use a larger candlestick here so you have a better visual representation of what's going on. Okay, so this long candlestick, this long red candlestick here, what happens is on the 5-minute mark, right? So that means at 9:30, you have another candlestick. At 9:35, you have another candlestick. At 9:40, you have another candlestick. At 9:45, you have another candlestick. Every 5 minutes, you have a candlestick which concludes what has happened in the past 5 minutes. But that is for 5-minute intervals. The same would apply if you clicked a 1-minute interval. This would essentially mean what happened in the next minute. Every minute is going to create a new candlestick. If you don't like all the noise and you just want it to get straight to the point, depending on which time frame you're interested in, right? So if you want to look weeks out in advance, right, you could look at weeks out in advance and essentially make each candlestick represent 1 day. What did it do overall for the day? Did it go down? Did it go up? And essentially that is how candlestick charts work. You got candlesticks within candlesticks. Now, if you still don't understand how these candlesticks form, I'll do a quick rundown here just so you guys could follow and don't necessarily have to pause. Okay, so back to this red candlestick here, right? So on the 5-minute mark, it opens at this point, right? And it fluctuates as the price of the stock goes up and down within that 5-minute time frame. Let's say it went up a little bit. So from the bottom, from the start, and it goes up, that means it was green at some point in time, because the highest range, which is what this wick means, right? The wick means range. It's like footprints in the snow. How far up did it go, right? So it went up, it was green, and it came all the way down, left some footprints, retracted a little bit, and by the end of that 5 minutes, this is where it ended up. So based off of this candlestick alone, you could see where it opened at in price, right? So you just move over here and look at the price to the right over there, right? How high it went, how low it went, which is this wick right here, and where it stopped at. Now, if it stops higher than it starts, it will be green. So that's how I know where it starts, right? So the bottom one is where it started. The top one is where it ended, because the top one ended above where it started. So it's green. And then the bottom one, so essentially for this one, it started here and it ended lower than where it started. So that's why it's red. So here we could tell the past 5 minutes, whatever time frame this was, and you could check the time frames at the bottom as well. Okay, so time frames at the bottom, and then you have price action to the right. So based off of this, you could kind of see where it's going. Now that you understand how the candlestick works, notice that there's a pattern, right? Candlesticks aren't just here or here or here or here or here. They follow each other, right? This is price action. This is a footprint. It's kind of like walking in the snow. You don't just jump from the 20-yard line to the 80-yard line. It's not really possible, right? Sometimes it may happen a little bit, and we'll talk about that in the near future. It's called gapping. But right now, for the most part, you can tell they're all connected, kind of like a road, right? So you just kind of follow the lines. If you could start determining where these lines are going to go, that is where you make predictions and you buy and sell stock to be, in the green. Okay, I know that was a lot, guys. Don't be afraid. Don't be afraid, guys. So now what we are going to do is we're going to break this chart down how I would genuinely break it down if I was to buy this myself. Okay, so we get to the 3-month chart. Okay, and we're going to change our intervals to 4 hours. Clean this up a bit. If I need to zoom in, I will zoom in. Okay. Okay, perfect. I like this. So now what I'm going to do is I'm going to use my trend line, and I'm going to draw different lines based off of the peaks, right? So I got my trend line, I got my lines here, right? And wherever I see a peak, essentially a strong peak, I am going to draw a line. That shows me that there was a lot of support or resistance within those price frames. So I treat it like a ceiling or a floor, right? All of this is imaginary, so you can't see any of this. But when you start to draw the lines, it starts to be clear because those imaginary lines, the price of these stocks actually represent, and other traders that are using similar tactics or similar indicators can see where resistance was before and where rejection was before. And we always know that it's always going to acknowledge those zones, whether it blows past it, comes back down, uses it as a floor, right? So as you see, the reason why there's a peak here is because there was a peak up here. So if you drew a line here, right, and there's already kind of like a dotted imaginary line, you can kind of see it here, right? It got rejected, it came down, broke past it, came down, and used it as a floor, and then so forth, right? So let's use our tread line, right? So draw a line right here. I just chose blue because I like blue. And guys, don't overthink this, okay? If you don't get it, just take a pause, rewind, take notes, and it would make more sense. Just gotta bear with me a little bit. Right, you try to keep your lines as horizontal as possible. Okay. And I'm also going to draw lines, guys, to show the direction in which the stock has gone. So we can clearly see here, but I just want to cancel out all the noise. There's a whole lot of hoopla here. There's always going to be hoopla when it comes to stocks, but we want to make straight predictions. Okay, so at the end of the day, I know that it was up here and it came down here. So how am I going to do that? I draw my lines. It was up there, it came down here. Okay. So am I going to draw my next line? Yes, you guessed it. If you didn't notice, it's okay. Down here, all the way up there. Okay. Just some more lines. Right. Okay. Up here, like that. Down here, like that. And we're going to do one more just for the sake of it. Up here. Okay, cool. Guys, so there are definitely more lines I could draw, okay? And it's basically wherever I see an imaginary floor or ceiling. Those are my support and resistance line. Now I know I said keep it as horizontal as possible, right? But that's if your intentions are to draw horizontal lines. If you notice, I see a ramp here as well. You guys, I know you see that ramp, right? Just think of imaginary floors and ceilings. Okay, so I'm gonna draw that. If you don't see it, that's okay. Because guess what? Most amateur traders don't see it. That is what's gonna separate you from an amateur, to be able to identify these things. Okay, it's like playing a video game. All right. Now I also want to draw another line for the ceiling here. You gotta bear with me, guys. Oh. There we go. I want to draw another line. This line's gonna be kind of hard. Okay. Let me clean that up a bit. It's kind of hard, guys. I'm just having little minor difficulties adjusting these lines. These lines are never going to be perfect, guys. Right? If it was perfect, we would all be rich. It is making predictions with what's happening here. Okay, I'm not the biggest fan of this. Okay, let's do that. Yeah, let's do that. There we go. That looks a lot better. So, guys, I know you see it, guys. I know you see it. This is what's going to happen now, okay? Now, my lines aren't perfect, right? I just drew wherever I see support lines, which is right here, which also acts as resistance lines when it's a ceiling, right? So this is a floor to this, but also a ceiling to this, right? We notice a pattern here. It went up, it came down, it went up, it came down, it went up. Where is it going, guys? Down, right? And you want to draw your picture as clean as possible so that you can make a sharper prediction. Because if my drawing's off, I might think it's coming down here, but it may not, okay? But I'm pretty confident in this drawing. It's not the best, but I think it's going to come down a little bit. And when it comes down a little bit, guys, what it's going to do is I think it's going to create pressure. And once it breaks out of these lines, it has to do something completely different. And I think it's going to either shoot up like this or it can come down. But in all honesty, this is going to come up like this. How do I know that? There are different patterns you can Google to understand what happens after you see a particular pattern. Now, I don't know what this one is called specifically, but don't worry, guys. We are going to look it up right now. Sorry, guys. By the way, this is my brand website. It's called luxhatsco.com. That is luxhatsco.com. I did not mean to throw this in there like an ad. I was just on my website, and so I figured I'd mention it as it popped up. Okay, so I got travel bags, I got hoodies, I got you name it. Just go on the website and see for yourself. Okay, now back to our regular scheduled program. Let's look up. So I'm going to turn the camera a little bit, show myself. I'm going to look up some stock patterns. And some of these things have names, right? So you got bear flags, bull flags. Just certain things you can familiarize yourself with so that you know what's going to happen next when you see these patterns. I'm so excited because guess what, guys? I think I found what I was looking for. So if you look this way, you see how there are different patterns? I don't just make this stuff up, right? We notice the zigzag. Okay, we notice it came up like this. There was a zigzag. So I'm confident that it's going to fill that little space that I drew there. And what's going to happen is it's going to create pressure and go up this way. Why would it not come down this way? Because that's just not how these patterns work. If you notice, it already went up. It's creating more leverage to go more up. If it was going to come down, there would be no reason for it to go up. So we can understand that it's going to do that, right? Now, for something that's coming down, right? Let's say it came down initially, right? It came down initially and it's creating more momentum to come down because it can't just go down forever. So that's why consolidate, it squeezes. And when there's no more left no more room left at the tip of those wedges, that is when it squeezes, right? So if you're confused, just look at where it started and assume that that is where it may continue to go, okay? For the most part, it's not always the case, but this started going up, consolidating, it's gonna go more up. Started going up, consolidated, it's gonna go more up, right? If it's gonna go down just to go back up, you might see a pattern like this. So to get smart in trading stocks, you can memorize these things, right? So you got the bullish double bottom, you got the bullish flag pattern, it's probably one of my favorite, the bullish pennant pattern, so many different ones. So now that you understand that, you have eyes of a pro now, essentially, okay? You got eyes of a pro. This is all the lines I just drew, it is now making sense with what that's gonna do. So how would you capitalize off of this, of a stock going down, right? What is this at? It is at $204.54. So what you could do is you could do a put option. And we talked about options before. What is an option, guys? I talked about it in videos, right? So an option basically gives you the option to purchase a contract, and a contract controls 100 shares. So anytime you see one contract, that controls 100 shares. That is just the unit of contract, right? One contract is 100 shares. If you want to control 200 shares, you need 2 contracts. But there's no controlling 150 shares. That's just the unit, okay? So essentially, what a contract is, it gives you the right, but not the obligation, okay, to purchase stocks at a particular price and sell it at a price that it is no longer at. So for example, let's say you have a stock and you think the stock is going to go down, okay? You can buy that option, and when the stock does go down, right, you can sell the price of your shares at the price it was before, essentially going back in time so that you don't essentially lose out on a stock going down. But that is to the person you're selling it to exercise the option. You as an options trader, you're not actually buying any stocks at all. What you're doing is you're buying the option. You're buying the right to go back in time and sell those shares. Okay? You're not actually the one executing selling those shares. So what that looks like as an options trader is, let's say you buy this contract for $50. And that's an example that is a very realistic example. You buy a contract for $50. As the stock goes down, more share owners want the right to go back in time to sell their 100 shares per contract at a previous price. So now your contract that you bought for $50 is now worth $400. And that is when you sell it to them, because they'll buy it from you so that they can execute. That is how you capitalize off of a stock going down. Long story short, based off of this chart, looking at this chart here, for the short term, not the long term, and I say the short term because I think this is going to go down to eventually go up. So you definitely want to sell your contract before then. You buy a contract, right? This price of the stock costs 204. You can buy the contract with a strike price of 204. As the price comes down to, let's say, 196, for example, the contract that you purchased for $50, giving someone the right to sell 100 shares at 204, a lot of people is going to want to buy that because the price of the stock would now be 196. So you take that contract that you purchased for $50, you sell it for $400, and now you have capitalized off of the markets going down. Okay. Now, it's very much the same, but the complete opposite for a call option. That was a put option we explained. Capitalizing off a stock going down. A call option is capitalizing off of a stock going up, right? That's like saying the same play here, right? Same play, guys. Let's say this comes down to 196. You decide to buy it at 196 or buy the contract with a strike price of 196, predicting that the market's going to shoot up. So what that does now is one contract controls 100 shares. It gives a stock buyer the option, okay, to purchase those 100 shares at 196, even though, let's say, the price of the stock is now currently $232, for example. I'll just pick the highest price here. So imagine that. Imagine somebody with all of this capital and you're giving them the right to go back in time and purchase 100 shares at $196. That's a lot of money, guys. I'll tell you how much money that person would make. Okay, let's do some math real quick. I got time today. We're going to do some math real quick, guys. Just got to find a calculator. Let me just find a calculator on my computer. Bear with me, guys. Bear with me. Okay, so we said, uh-oh. Okay, so I have my calculator here. I did not mean to get rid of my other browser, but it's okay. Okay, so for the sake of this example, right, let's say you are buying a contract, or you are selling a contract to someone that wanted to buy this stock, right? So you just gave them the right to buy it at 196, even though if the stock is now at $236. So what do? 236 minus 196, right? So 236 minus 196 equals $40. But don't forget, one contract controls 100 shares. So $40 times 100, that is $4,000. So that is how somebody with a lot of capital was able to make $4,000 by essentially placing the capital into this stock at $196, paying you $400 because you bought it for $50 and you sold it for $400. Don't ask me where I got the number 400 from. I'm just explaining to you how the price of an option can jump from $50 to $400. It could jump from $50 to $2,000. It depends how extreme the price has gone from the strike price you chose. Okay? Now, that was a lot, and that was very informative information. Now, let's say options is too complex for you. You're just not interested in that. At the moment, you only have $200 to your name. What you could do is, as you see this, you wait until it is 196, and you can place a limit order so you don't miss it, right? We talked about market orders. Market orders are when you just click buy one share, and whatever price is flashing at is the price is gonna sell it to you at. That's not good because you definitely don't want to let the market decide the price for you. You want to be in control and do a limit price. So that way, even if it was to move there really quick, you're not missing out. Because the matter of seconds from you blink your eyes to place that order, you think it's at 196, now it's at 205, and you completely missed it because let's say you only had $200 to invest. So that is why when you place a limit order, 196, as soon as it touches it, bam, and it shoots up, you're already in. Now you're in the green. How much would you make if it went from 196 to 236? You guessed it, $40. Not 4,000 because you only bought one. You only bought one. Now if you bought two, it would be $80, but you need to buy two shares, which costs 196 times 2 equals 392. Look at that, ladies and gentlemen. Okay, now I know that was a lot of information. Okay, but it gets better. It gets better. We got to go more in depth. Okay, that was NVIDIA, right? Now, do you guys know what futures are? Probably not. The futures market is very different from the stock market. I lied, it's not very different. It's very similar actually to the stock market. And if you notice, there's a strong correlation between stocks and futures, okay? So based off of how futures are being traded, you can determine how particular stocks are being traded. Usually when futures are bullish, stocks are bullish. Just in general, not anyone in particular. So you just want to make sure there's a clean correlation between those two companies. How do you do that? You pick a futures that you want to look at, and essentially just how I looked it up with stocks, you do the same thing for futures. Now for stocks, the same thing, right? You're interested in NVIDIA, you've got to make sure there's a correlation between the two. So now that way when futures is really pushing up, you know NVIDIA is about to push up as well. Okay, and if it doesn't match, that might be something to hold off on because you do not have a strong indication that what you've seen is what's going to happen. The more tools you use, the better indications you know of what's going to happen. So I'm very confident in this drawing that I have. However, if I think it's going to squeeze up, but futures is still showing me there's a trend going down, I might wait a little bit until I get confirmation on futures. I see that it wants to go up a little bit, and essentially I'm ready. I get the green light for both my stocks. I get the green light for both my futures. I'm doing buy, I'm bullish, or I'm buying call options, and we're running it up. That's exactly what we're doing. So now, let's go to futures, guys. Let's go to futures. So Robinhood Legend is a good tool. I like to use that tool. So Yahoo Finance is good. It's good for searching stocks. If you like those charts, nothing against Yahoo Finance, right? But if you like those charts, cool. But just Robinhood Legend is just a little bit more cleaner for me. Okay, and that is why I used it. Look at this, guys. Look at this. You're gonna see a lot of lines. Don't be afraid. I drew these lines. And the thing is, I draw these lines like days and weeks in advance. And I draw them all the way across my screen. And usually the markets respect those lines. That also gives me confidence in the lines that I drew. So when I'm drawing a line, I'm not erasing it and drawing it again the next day, unless it needs to be that way within like a small time frame. Like let's say it's a day chart. Obviously what I drew yesterday is not going to reflect in today's chart, and so I might need to draw new lines. But if I'm drawing lines 3 months out, 2 months from now, my lines are still valid. I drew my lines 3 months out. I can still see which support and resistance zones it is reaching, okay? So here we have futures. Now, we talked about what options are, but we didn't really talk about what futures are. I just said that they move similarly. So options, it gives you the right but not the obligation to purchase those 100 shares per contract by the expiration date, meaning you don't have to. But if you wait till it expires and you don't sell the contract, or you're a stock buyer and you don't exercise the contract, what's going to happen is the contract gets expired worthless. Okay, so that $50, it could be $400. If you don't sell it and it expires, guess what? You just lost it. Futures is different. Futures, you have the obligation to purchase those futures by expiration date. So you as a futures trader, the goal is never to hang on to futures until it expires. The goal is to sell it before it expires. That is the goal. And then you let the other person on that other end who purchased it from you, if they are not actively trading futures, they will not be obligated to make those purchases. Now, we can get into the history of futures in a later video, but it's very interesting how futures came about. If you want to look at that on your own, do not hesitate to do that, okay? So now that we talked about futures, let's take a look. This is futures. As you can see, I have a whole bunch of lines here. I drew these lines a while ago. Okay, this is a 15-minute chart, which means each of these candlesticks represents 15 minutes. So this is days worth of trading, guys. Right? I drew this diagonal line, this ramp a long time ago. What did it do? It bounced off of it, came up, bounced, and then it broke. So they respect these lines. Now, in the beginning of the video, which was about, what, almost 40, 45 minutes ago, so that's 3 candlesticks, it was down here. So I foreseen it going up to test this support line. And so that is exactly what it did. Now, if I zoom in, it pretty much touched this line already. So 2 things could happen, guys. It could either blow past it, or it can get rejected and come back down this way. What do I think it's going to do, guys? I don't know. Let's see. I look at my stocks. I see it has yet to fulfill this range here. So it has yet to come down and test this line on stocks or on this particular NVIDIA chart, right? So looking back at this, while you have people who aren't looking at this, which is fine, they're confused. They're 50-50 right now. But I'm not 50-50. I am 75% sure that this thing is going to test this line and come back down this way. Okay, just based off of this, I just feel like the patterns need to respect each other, and right now they're not respecting each other if this thing were to go up. But doesn't mean it can't shoot up and go up, guys. And oftentimes there may be a fake out. You may see it come up here a little bit, as this lines are not set in stone, guys. I drew these lines with my bare hands. They are not perfect by any means, but I just know that it's not ready to go all the way up here. My picture just looks way too clean. It tells me it needs to come down some more. So with that being said, you know what we're gonna do, guys? We're gonna do a sell. Okay, now futures is a little bit more simple, right? I just do a sell. That's basically betting that it's gonna come down, right? I do a limit sell. For the sake of this video, just so you understand, I'm not telling you guys to copy what I do. Instantly, I may be down a little bit, right? I'm down $2, $2.50. I'm gonna set my limit to where I don't want to lose too much money, right? This is called, my stop loss. And then here, I'm gonna set my profits where I need to take profit. Okay, so essentially what I do is I create a range. So if I'm wrong, it'll sell me out up here. So if it goes anything past this, which is my drawing, I'm not really focused on the numerical values. I am respecting the numerical values, but it's not based off of that, right? It's based off of my drawing, okay? And I'm confident in my line here, and it needs to reject my line. And once it does, then I know it will be green. However, I don't know how long this is going to take, because it might take 3 or 4 candlesticks, which you might think is quick. But remember, we're looking at a 15-minute candlestick chart here, which tells us that it might take a whole hour just to get 4 candlesticks to start leaning towards the direction that I think it's going to go in. So we're going to leave this alone a little bit, and we'll come back to it. Right now, see, I'm down $21. Don't panic, guys, right? It's all about range here. Okay, now someone who's inexperienced might get scared and might sell themselves out too quickly, but we're not going to do that. Now, typically what you want to do when you're actually trading for yourself, you want to make sure there's confirmation. So the ideal thing to do would be to wait until you see candlesticks solidly past these lines to make a determination, not doing it at the actual line. I'm just doing it at the actual line because, like I said, I have confidence in my other chart. And for the sake of this video, right, we don't want to teach bad habits here, but I just need you to understand how this thing works. Now, what we're going to do is we are going to look at another, let's look at another company. So let me go back to Yahoo Finance real quick. I'm not sure which tab I was using. I have so many tabs open. Yahoo Finance. We got Yahoo Finance. And I'm not editing this video, guys. I'm giving it to you guys. Raw and uncut, okay? So we're back on Yahoo Finance. Okay. We go to markets. Okay, and notice how there's futures here too, right? So if you're really interested in futures, you just go to futures right here. But we're gonna go to Yahoo Finance. We're gonna look at large cap. Only because I want a company that has a large market cap. Now, aside from the positives of a company having a large market cap, why that could be good, it also means that it has more volume. What does volume mean? It means stocks being traded, per session, right? So volume means liquidity. Liquidity means easier for you to buy and sell stocks, right? It's just more liquid, essentially, if that makes sense. Think of it like Instagram. Instagram, a celebrity who has like 50 million followers, their likes are very liquid, right? They're just going to, as you refresh it, the likes are just going to happen versus, let's say you only have 10 followers, you might not get any likes, or you might not get any trades, essentially, as it is just slower. So that's essentially another positive with having a large market cap. It means that the market for that particular company is more liquid, the volume is higher, and so therefore you know, your predictions are easier to make, essentially, if that makes sense. So let's look at, I don't know, something you guys are familiar with. Let's look at Apple. Why not, right? Apple. So we're going to look at Apple. I'm going to come up top here, right? And I'm going to search Apple. Look at that. Now, for the unexperienced eye, this looks boring. It's like, what am I looking at? All this green, red, green, red. But we talked about this already, right? Let's do a 3-month chart. Stretch that out a bit. 4 hours. All right, I'm going to zoom out a bit. And we're going to start drawing lines. But before we start drawing lines, let's talk about indicators. Because we talked about it before, but I never showed you guys. So there's so many different types of indicators, probably over 1,000 indicators of those basically AI tools that generate drawings to tell you what the stock has done and where it's going to go. Okay. Now, the 3 indicators that I personally like to use, they're called Bollinger Bands. You got the MACD and you have RSI. Don't hang yourself up too much on these names, okay? That's just what they're called. But Bollinger Bands, which I already have right here, okay, I just clicked the hide button so that you guys can see the raw chart. But I'm going to click unhide so now you can see Bollinger Bands. Bam. These are Bollinger Bands. Now you might be like, what is this 2B looking thing? It has to respect the 2B looking thing, guys, right? So you zoom in a little bit, it cleans up the picture for you. Even though this may look confusing, I'm going to make it look simple. So let's say the stock is here. It is bullish, meaning that the buyers are in control and it is likely to go up. Notice how it respects this middle line right here. Okay, this middle line represents the moving average. Okay, so it just takes an average of all this movement and it says, okay, where is it at? Which is right here in the middle. Then you have the bottom Bollinger Band, which acts as support. So think of it as a floor. If it's touching the floor, it's going to be hugging the floor. And then you have the top Bollinger Band, which is resistance, but it follows that as well. And it always respects the moving average. So it's never trading in the middle, it's picking a side. So we know that if it's up top here, it showed no indications of crossing, and you can predict that the stock is going to go up. So based just off of that information, with Bollinger Bands, it's on this side, you know it's going to come up. Once it makes this crossover, typically it comes down. Now I know it's not showing that all the way. However, that is okay because this stuff is not magic, right? It's just predictions. So you just want to be wary of what it's showing you, but just understand what you're looking at. It'll help you to make your own determination of what's going to happen. And all these different colors here, this is just volume, right? We talked about liquidity. We talked about the buying and selling of shares, and it just shows who's more in control with all the trading that has happened in this particular time frame. So green, 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 right? So it ended up green, meaning the buyers were in control. It got higher, meaning more trades were happening in a particular time. They were getting more confident and more confident, and that is why it is going up like this. And then red, right? You had the sellers in control for a little bit, right? So it didn't just climb up like that. It came down a little bit, and so forth. That's not really an indicator. That's just volume, something to keep in mind. And we will talk about volume-based indicators in the future as well. That is why it's important to subscribe and make sure you pay attention. Here you have something called a MACD. This is one of my favorite indicators. Why? It's simple. It's clean cut, right? It looks crazy. You look like some worms, right? But it's going to make sense here, right? So even if you are not looking at the chart, based off of this, it just clean cut tells you what's happening, right? So we talked about the bars. This is also volume as well, representing volume in a different form. And you notice that there are 2 tones to each of these colors, right? You got green and then you got red, and it's 2-toned. So essentially, this means that the dark means that This thing is deep in the red, right? Like it's coming down. And as you see in a lighter tone, it tells you that it can potentially start going up a bit. That is why the last two bars here, if you could see it, these are lighter than this. So you know as this is getting smaller, it's a reversal that's about to happen. It's changing to green. It doesn't just go from big red to big green. No, it's darker red. Darker red starts turning lighter red, meaning it wants to get green sooner. It's getting smaller, 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 smaller. So now you know it's green, right? So if you were to buy, you would buy around here without even looking at the chart. You know you could buy around here, right? That sounds silly though, right? You use as many tools as possible. I'm just telling you how to have confidence in whatever indicator tool you're looking at and use it with everything else that you have. Okay, now with that being said, it climbs, right? It's light green, light green, light green. Once it starts turning dark green, you know maybe this thing wants to turn red, so you got to be cautious. But you'll never really know for sure, so you just keep in mind. But as this gets dark now, you can see a reversal is happening. It's darker, it's smaller, it's smaller, smaller, and bam, it's red. What's happening here? If you bought here, you know red is coming. You probably not lost some money off of this down. If you're in it for the long term, this is irrelevant, and we need to look at a chart that is further out. Now you have the MACD. This is as simple as it gets, guys, right? Now, I forgot something when I mentioned the MACD. I'm sorry, this is the MACD, this is the RSI. So for the MACD, these two lines here also represents when a reversal is happening. Okay, so this means that it's underbought, meaning this is discounted. It's red, it's cheap. Think of red, cheap. Don't think of it as bad. Think of it like it's discounted, it's on clearance, right? So now once these lines cross, that tells you, hey, there's a reversal happening. So you know if you buy here at this cross, you can capitalize off of it going up. And then when it reverses, you know, uh-oh, now's not a good time to buy. You might want to sell too if you want to secure your funds. And that's exactly what happens. It comes down like this. And here, perfect time to buy as well. Goes up and so forth. This is the RSI. This tells us how strong, the stock is underbought or overbought, essentially, right? So here it's overbought, meaning life looks good. It's green, stock is up, but just know it's coming outside that fence area, and it doesn't like coming outside the fence, meaning it has to come back in the fence. Coming back in the fence means the stock going down. And what happens? Bloop, 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 bloop. Stock goes down. Right here, yes, you can have bought here, but had it been outside the fence here, meaning this is super on clearance, now you can essentially buy. It's a good opportunity to buy. So long story short, this is how indicators work. And you have so many different indicators. Notice how all of these are very different from each other. You have over 1,000 indicators to choose from. Look at them, play with them, see what you like. Maybe some of them, look more appealing to you than what I'm showing you now. And you can also adjust these numbers too. So like everything gets technical. These fences, right? So usually when traders talk, they say, oh, it's approaching the 70. What does that mean? It's approaching the fence, guys. It is approaching the fence. If it's past the 70, for my numerical guys, my technical guys, numbers matter. Okay? I mean, if you're trading stocks, numbers matter. But some people, we don't talk about fence and all this other stuff, right? Is it past the 70? Yes, that means sell. Is it below the 30? Yes, that means buy. These are what these things mean. So familiarize yourself with this and make it work for yourself. So now, let's talk about buying a stock and it not doing what you want it to do. Okay? This is what you're going to do. You're going to cost average. Okay? You are going to cost average. What does cost average mean? Let's say a stock costs $100. You want to buy one share. You think it's going to go to 110, and it decides to go down to, I don't know, $50, which is terrible. So essentially what you do is you buy more, right? Think of it like sneakers, for example. You buy a pair of sneakers for $100, it goes down to $50. So you don't get rid of the pair of sneakers you had. You buy another pair of sneakers, make it a deal, right? So I'm sorry, 100 plus 50. Oh, what am I doing? 100 plus 50 equals to 150 divided by 2, that's 75. Oh, shoot. Sorry, guys. 150 divided by 2 equals 75, right? So now your cost average is 75, meaning instead of the initial stock that you had, it needing to go above 100 to make profit, this just needs to go above 75 now, even though if that price is at 50. So that's how you bring your cost average down. Never panic sell because a stock you think was going to go up goes down. The answer is cost averaging, and that is why it is important to have risks so that you could, or to identify risks and not trade your whole portfolio, so that you have money and capital aside to counter whatever that stock is doing that you did not think it was going to do. Okay, I know that was a lot of information, guys. I'm bringing the information. I'm bringing you guys content. That's what you wanted. Now you gotta make sure you support and you subscribe, guys. Okay. So let's see what we have here. I'm trying to open up my. Oh, there we go, guys. So now look, I am up. I am up on the futures. I am up $19. And so what I'm going to do now for the sake of this is I'm going to drag this down to $10, and it essentially filled me out. So I just made $10, guys. I know that was kind of quick, but what I did was I took my stop loss and I moved it to above the dollar profit margin, so around $10, so that way I was able to secure the funds. And I don't want to say it's that easy, guys, because can be very complex. But you guys see me make money on futures in real time. You guys seen how I trade based off of the different stocks that I have. And essentially that is what you want to do, right? So now you guys know what to do when it comes for looking at stocks and futures as well. All good stuff, right? Kind of want to go back on Yahoo Finance real quick. Right, you could do the same thing for crypto, but they all move different. Now, one important thing that I haven't really talked about yet, because we kind of identified things and just jumped right into it. Definitely not telling you guys to jump right into doing things, right? What you want to do is you really want to understand the stock that you're looking at. You want to be watching this thing, and now you will kind of get the patterns on how a particular stock trades, because every stock trades different. Every stock has a personality. You need to understand that. So this is not a simple observation like, oh, I noticed in the morning all stocks tend to go down, or maybe all stocks tend to go up. None of that is necessarily true, okay? But you can see the rate that it goes down and the rate that it goes up. Just different things that you may not even be able to describe. That is why your most successful traders, they just have some type of intuition with what a stock is going to do, and that's what's going to separate you from your average retail trader, right? You know how they say follow your gut? Yeah, you got to follow your gut, because subconsciously, our subconscious mind is very powerful, and there are things that we observe and we may not be able to translate, or we may not be able to consciously acknowledge that. That is why the gut is important, right? Nothing against my spiritual folks, but this is not like a spiritual thing. This is logic. This is logic. That is why when you need to use the bathroom, for example, and you get closer to home, you really need to go, right? Your mind is telling you you're closer to home. No matter how much you think, and no matter how much you try not to think about waterfalls, you're still going to need to use the bathroom. That is because your subconscious is powerful, and it knows that you're close to home. You can't trick your mind. And it's the same with stocks, right? You got to watch those stocks every day. And at the end of the day, these are just numbers. These are just tools. But you take all of that with your intuition and you make a decision, right? I know that was a lot, guys. Let me know what you guys want to see. I hope this video was good for you. It's not going to be much edits. It's not going to be much music. Might add some captions, don't really know. But I know I brought you guys some good stuff.